So Dom Chu has been taking a look back at what exactly did happen in 2015 when China last devalued its currency, Dom, and it proved to be some painful for U.S. stocks.
It was painful. What the interesting part about this is, by the way, we are at near session lows, off by 2% plus in the Dow Jones Industrial Average at this point. The interesting part about the moves today, first of all, we should point out that when that surprise devaluation happened in the early mid part of August, back in August 11th to 13th, 3 consecutive days of devaluations, by the way, deliberate devaluations by the Chinese government there. On the first day, the S&P 500 dropped by about 1 1/3% at its lows. It closed down by about 1% or so off by the time the day was over for the S&P. So we're already much further beyond that to the downside. That's something we'll keep an eye on. But with regard to what happened with China, a different picture back then, because at that point, what China had to deal with was a steady appreciation of its currency. Now, that was a decent thing to have back then because China said that they were trying to convert more towards a consumer-based economy, more services-oriented, less dependent on those exports. So they didn't need perhaps some of that yuan devaluation to make their exports a little bit more competitive. However, we did see a slowing Chinese economy, kind of like what we're seeing right now, but much more so in terms of magnitude. Things were slowing down markedly then. And one of the things that we saw because of that is massive amounts of market volatility to the downside in China. That's the one thing that we're seeing a little bit more of now, but not quite as much as we saw in 2015. As we put some of those bullet points in context with charts and the markets, the reason why it's important is you can see right here, that August 11th through 13th, 2015, this is, by the way, 2015 charting of the Chinese yuan versus the S&P 500. You can see that move higher did move a little bit to the downside for the overall S&P, but it wasn't until about a week or so later that things really took a turn to the downside. The S&P fell by just around 11% at the trough levels of that move in 2015. It rallied back, but the big deal was it was acting in concert with other market concerns. It wasn't just China. It was fear of interest rates here in the U.S. and that global economic slowdown that you guys have just been speaking of. One of the other things that we'll kind of put in context here overall with the way that the markets are moving is this idea that if you take a look at the way that the Chinese market and the U.S. markets have kind of moved, remember back then, China kind of hit highs going into 2015, and we saw all that downside market volatility. The S&P 500 did not have nearly as much of that kind of volatility, but it's still, you can see that gap there between the U.S. markets and the China markets. The interesting part about this time around, Sarah, is whether or not the leverage is there from a market perspective between the U.S. or China. You can still argue that China is playing second fiddle to the U.S. in terms of market moves. But if President Trump feels as though the U.S. market can sustain it, this might be a very, very big tactic to use with big consequences, positive or negative, guys.